We're about 2 hours into the first trading day of 2024. The S&P and Nasdaq taking a hit, but many strategists are optimistic about where the market is heading through year end. We've covered several bullish calls for the S&P 500, but our next guest is more cautious. We have Burns McKinney, NFJ Investment Group Managing Director and Senior Portfolio Manager, joining me this morning. And Happy New Year to you. So I want to break some of this down because a lot of people are still feeling very bullish now, but could it be that a lot of the gains have already been taken at the end of the year and we're just sort of treading water at this point as we're looking ahead to potentially 6 rate cuts that some investors are pricing in?
That's definitely a possibility. I mean, the way I've sort of been viewing it is that the stock market had a great 2024 during the fourth quarter of 2023. And you've seen really the one fulcrum upon which stocks have been trading on for the last really 12 months have been what's going on with interest rates. And so when you had the great pivot of 2023, when the Fed said, okay, we're going to move from rate hikes to rate cuts, the markets moved pretty quickly. There is some concern they might have gotten ahead of themselves a little bit. I mean, it's sort of, I like to think there's an old book, you give a mouse a cookie, because you give a mouse a cookie, he's going to ask for milk. Give him milk, and so on and so on. And that's kind of how the stock market is a little bit. The Fed tells the markets, okay, maybe we might cut rates 3 times in 2024, and the markets say, hey, no, how about 6 times? And as a result of the fact that they've already, in many ways, priced that in, a lot of those gains may have been had. If you think about, well, what are the ways that the market could appreciate at a fast pace in 2024? You've got, the S&P's trading at, 21 times earnings. You shouldn't expect a lot of multiple appreciation. We've gotten that. Earnings are forecast to grow at 10 to 12%. So that's pretty optimistic too. And we're already pricing in 6 rate cuts. And so I think the risk reward is perhaps behind us a little bit. That said, I think that, interest rates, will be coming down a little bit. And so, it's hard to really, warn against fighting the Fed and fighting the markets on that front.
It's true. So then what do you make of the breadth of the rally that we've had so far? Obviously, a lot of focus on the Magnificent Seven, but also small caps as well.
Yeah, I think that's one of the best stories that came out of the Fed pivot last quarter was really, everything rally. It had we call it the everything rally, and everything moved pretty quickly. But what was kind of interesting to us and exciting about it is that the breadth did expand. You kind of went from the Magnificent Seven to the mundane 493, and you saw small caps do well. You saw a lot of what actually hadn't performed well in 2023 really rally. Whether it's some of the interest rate sensitive names like utilities or REITs, some of the financials, even regional banks did pretty well. And so that is one thing that investors can kind of look forward to in 2023 is that maybe don't go all in on the market, but it should be a good market for stock pickers based on the fact that with that expansion, the other, the rest of the market outside of, that Magnificent Seven is really hasn't gone anywhere for the last couple of years. And so, there's some areas where earnings have continued to grow, and as a result, valuations are more appealing. But you do need to be a bit more selective this year rather than just going in and just, loading up on the S&P 500.
And so, of course, as we look at the inflation story here, looking at what the economic picture is telling us, given that still some of the Fed's medicine hasn't made it all the way through the economy, when you look at labor force participation, when you look at where rents are headed, what is that signaling about where the opportunities are ahead and what markets should be paying attention to?
Well, inflation definitely is falling, even more quickly than investors have been, taking account for. If you look at, core inflation over just the last 3 months, and you annualize that, you're talking in the mid 2% range. And in fact, the biggest driver of that has been shelter costs. And, those are kind of, that's kind of stale data. If you look at real-time data for that and plug that in, inflation may already be at the Fed's target. And so one of the reasons the Fed does have the ability to cut rates this year is just simply the fact it's not that they're cutting rates because, to combat a recession or economic weakness. They're just cutting them just to kind of keep up with inflation to keep from actually becoming more restrictive. And so, that bodes well for, economically sensitives. Places like value stocks should actually, do pretty well. In general, that's one area of the market that has lagged. We're looking at reversion to the mean. And, for example, the U.S. large cap index has lagged the U.S. growth index by several hundred basis points per year over the last 5 years, the last 10 years. As a result, the discount to which it trades to large caps is is much wider than its historical average levels. And so, we are suggesting to our clients to, maybe focus on kind of, looking between the sofa cushions, looking under the mattress at some of those unloved value stocks that might have a chance to make a comeback this year.
So Burns, give us some names, some of your picks that you like in this environment.
Sure. I think one that stands out because of the fact that, utilities sector, again, we don't necessarily see big double-digit gains this year. And the utility space is one that did lag last year. And as a result, there's some values to be had. One that jumps out would be NextEra Energy. I mean, it was a huge laggard in 2023. And as a result, it typically trades at a nice premium. That premium's gone. I mean, that's a name that right now, you get into NextEra at around 18 times earnings. This is actually the first time that NextEra has traded at a discount to the S&P 500 since 2017. Among utilities, it doesn't have the highest absolute dividend yield, but it has some of the best growing dividends. They've tripled their dividend payout in the last over the last 10 years. And for those who aren't familiar, what NextEra is, it's the largest electric utility in Florida, which on that front, you're getting a company where you've got positive population growth demographics. You have a very friendly regulatory regime, but typically what you'd end up paying a premium for is the fact that it's also the U.S. leader in clean and renewable energy. And, oftentimes you pay a premium for that. You're basically getting that side of the business for free, just sort of getting ahead of the game on the ESG front.
And for people who got ahead of the game when it came to the bond market, what are the expectations here? Given the volatility that we saw towards the end of last year, what should we expect going into this year when you have the Fed pausing and potentially pivoting at some point?
Volatility should probably remain at a somewhat elevated level. I think just as a result of the fact of the policy uncertainty and that, you are having a bit of a sea change with respect to what, you've got the just central bank policy. There is a lot of uncertainty this year with respect to both that as well as geopolitics. I mean, we have, whether it's, the war in the Middle East, a war in Ukraine. And, the fact, I think, one thing that could throw a monkey wrench into a lot of space is you have elections being held around the world in addition just to the U.S. election. I think that's something that, may keep investors on their toes. And so, if one is going to expect to see volatility, I think, one way investors can kind of play that, or at least try to blunt that volatility, is look for names that maybe don't necessarily move quite so widely with the markets. One place that jumps to mind would be, stocks that pay and grow dividends, because we always say that, capital gains of a name can be positive and negative, but the dividend component of return, that's always positive. And so the dividend payers have historically, over at least rolling periods, have always tended to be less volatile than the broader stock market.
Certainly some caution to note ahead, even if markets, at least for now, not paying that much attention to it. I appreciate you joining me this morning. Burns McKinney, NFJ Investment Group Managing Director and Senior Portfolio Manager. Thank you so much.
Yeah.